to sort of say inflation and growth are true risks. They're diversifiable risks. So if you assemble a portfolio thoughtfully, you can mostly eliminate or dramatically reduce the amount of variance in the portfolio that is due to changes in expectations around both those axes. There's the liquidity, risk premium, sentiment kind of risk, right, which is non-diversifiable, right, as you say. That is a risk that you're rewarded. That's why you earn a premium on the risk parity portfolio, or one of the reasons you earn a premium on the risk parity portfolio, because there's no costless way to hedge that risk, okay? Costless being critical. In other words, you need to pay a little bit, in theory, to hedge that risk. And then there's the Fed policy risk, which I like to frame as a shift in expectations about future cash rates, right? So if future cash rates are shocked higher, then investors have a higher incentive to move out of risky assets into cash, all things equal, right? So you need to lower the price of risky assets to the point where the expected premium that investors are going to earn on that is high enough to continue to entice investors out of cash when cash investments become more attractive because the Fed says we're going to raise rates, right? So those latter two things are risks that cannot be diversified away. And accepting those risks is why you earn a premium, a long-term premium on the global risk parity portfolio, right? And you can hedge those risks, but we shouldn't expect to be able to hedge those risks costlessly.
For free,
right?
yeah.
For free, right? So this is where I think it's really, I'm curious to explore, right? So you've got this kind of first responder portfolio that is kind of meant to hedge against both that sentiment / liquidity risk, right? Which is kind of that basically strategic long vol exposure, right? And then more of a sustained series of shocks to expected future cash rates, which is where you get these longer drawn out kind of bear market type environments like we're currently. You've got this trend sleeve, and then you've got more of this absolute return sleeve, right? So let's dig into how you think about constructing the most efficient first responders sleeve.
Yeah, I think efficiency there, again, is when you think about what you're trying to hedge, and then what type of scenario you're trying to hedge for. Like, are you trying to hedge for just downside equity risk? Or are you just trying to get long vol exposure across the board? I think we would err more on the side of, again, depending on the client, but say someone came in and said, hey, we have no biases. We want long vol exposure, multi-asset class, because we just don't know where the event will come from. However, normally these events have cascading effects on various asset classes. Now, we haven't really seen it in the FX markets for quite some time up until this point, right? But, would you say maybe 5-10 years ago would you want FX vol exposure? Probably not. But now would you? Absolutely. Would you want rate exposure? In the past 10 years on the long vol side, probably hasn't done too much for you. But this year, it is, especially on the trend side. So within that long vol side, you can structure in a way to more hedge for that immediate, quick, and deep drawdown. Or you can implement those strategies for more longer drawn out periods and buy options that are 2 years out as opposed to 1 month out or 1 week out. So there's lots of different ways to implement that. Again, what is the expiration of those options, and then what markets are you playing in? And we would diversify across kind of time as well as velocity of that event. And then I think you do something similar in the trend following space. Are you more shorter term trend, medium term, or longer term? And then how are you expressing the different asset classes that trend is investing in? Are you kind of equity heavy because equities tend to be are the most deep and liquid markets? And they've done quite well for quite some time. Maybe you have some trend following managers that have gravitated more toward equities, and equities have been a big part of their book. But if you rolled it to this year with that type of exposure, you're not doing as well as the guys that have sort of taken a more true kind of equal risk allocation across the board. So it gets back to, again, it's client dependent on what they're trying to hedge for relative to whatever else is in their plan. And then how much do they think about investing in terms of absolute return, absolute risk versus relative return, relative risk.
Right.
Like
because you have to hedge different risks in one case or the
exactly,
other. Yeah.
exactly. I mean, again, going back to the pension plan example, you could hedge against some sort of major credit event, right? But you're going to realize that event in the equity markets as well.
Yeah.
Like, these things have cascading effects. So why not try to eke out as much return or eke out as much diversification as you can across all those different types of risks, because you just don't know where they're going to come from.
Yeah. Well, it's interesting because when we talk about that tail protection or that first responders part, it's a very different amount of first responders that you need when you're dealing with a risk parity portfolio, which tends to have more of a normal distribution, much thinner left tails. People think about tail protection when they're dealing with a 60-40, 80-20. Yeah. And when you're having that conversation, you're saying, yeah, so this is how big your tail protection is. So how much protection do you want, right? You want to mitigate against half of your 50% loss in 2008 scenario? Okay, well, this is how big your first responder allocation needs to be. And that means that there's going to be a massive amount of drag sometimes. That requires you to truly understand and have a stick-to-itness, right? This is, again, why I like the risk parity side, because for risk parity, for anything that's diversified and approximate a Gaussian distribution, you're going to have a much easier time allocating a small sliver to the first responders portfolio, right?
And it frees you up intellectually, where if you're going in strategic asset allocation is a risk parity type portfolio, you're not automatically thinking about downside equity risk in first responders. You're thinking about multi-asset class vol, right?
Right.
Well, I think you're thinking about hedging against growth risk and hedging against inflation risk, right? Yeah. And like major inflation shocks or major growth shocks that are mispriced by the market, and also policy risk, right? Like you're hedging in the Eurodollar market, right? So like, I think growth risk you can effectively hedge exclusively with equities, because if you're going to have a financial crisis that's going to dramatically hit growth, you're also going to get a downward spiral in commodities, right? So I just think that you can sort of apply the risk parity framework of growth and inflation, liquidity risk and policy risk in the same way to your first responders basket, maybe as a place to start.